This is the Financially Simple Podcast, the show dedicated to destroying the complexities of money for today's small business owner. The content in the show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor or conduct your own due diligence. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor only conducting business in states where it is properly registered or is excluded or exempted from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Here's your host, pizza-loving, certified financial planner, Justin Goodbread.
And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today we're going to continue our conversation about long-term care. Last podcast episode, I spoke about what long-term care is, the sheer amount of numbers of people who are going to be affected by long-term care, the issues that long-term care has done in my family, speaking about my grandmother, the things that we see current clients dealing with. I mean, it's just an amazing scenario. So we talked about long-term care, and today I want to deal with how do you pay for long-term care? We talked about the cost involved. Some parts in New England being $120,000 a year. Other parts around the country being as low as possibly $40,000. We talked about how expensive it is to place a loved one in the care of another in the latter parts of their lives. We also talked about how long it could last. So today I don't want to cover all the topics, so I had to bring an expert in. I'm going to use that word here loosely. My long-term cohort, friend, business partner, Jim Detar, is the voice that you'll hear on this particular episode. Jim and I go way back. We've known each other and worked together since 2004. Typically, I'm the person out doing the marketing, doing the conversation, and Jim is the guy, as he says, running around behind me, picking up the pieces and making the company run. So if you're a client and you've listened to the podcast, as I know several of the clients do, you're going to enjoy listening and laughing with us as Jim and I talk today. If you're not a client and you're a business owner, I got to tell you, and I'm not just saying this because he sits there beside me, he's one of the smartest people I know. He is loyal, and when it comes to this area about long-term care, he has some certification. He doesn't currently have them. We just felt like it was a waste to keep him up, but he had some certifications that were on a national level talking about long-term care. He is an MBA, and he's also a certified financial planner. I'd say he knows almost as much as me, but that would be, we like to have a good time. So
a little more once in a while.
All right, buddy. You ready to do this?
I'm ready.
All right, so let's talk about long-term care insurance.
Okay, long-term care insurance is one of the many facets that can be used to help pay for the cost of long-term care. The insurance has been around for about 25 years. In fact, the earlier policies came out in the late 80s, but it started to take off in the 1990s. And interestingly enough, when I started in the financial services business, I started out selling long-term care policies for John Hancock. It's a great product. It was near and dear to my heart because I also have had personal experiences. I had grandparents who spent down every last penny of their savings on long-term care to the point that one of them went on Medicaid and the other one, upon my grandmother's death, all she had was $500 left to her name. So the costs, the associated with it have continued to rise, and the ability to insure the product has gone through an extreme revolution, specifically in the last 5 to 6 years, largely because this is a high expense care that most people use. And usually when we're trying to cover that risk, we use the pooled risk or the insurance to cover that.
So let's hold off a second. So one of the things I do is I interrupt myself and everybody on here so I can make sure I'm with you. You just used the term pooled risk. Okay, that's an insurance term. That means what?
That means that a large number of people pull together. Not everybody goes through long-term care. In fact, if most people could afford to pay not to have long-term care, they probably would. But because not everybody goes into long-term care and spends money in long-term care, everybody who has insurance, the people that don't go on claim, help supplement or take care of the expenses for the people who do go on claim. It's just a basic insurance thing. That's why you buy insurance. That's why you insure your home, you insure your car. It's called pool risk. In other words, you're able to get coverage for catastrophic loss or expense, such as long-term care, at a lower cost.
So let me rephrase what you said back to me in financially simple terms. We realize there's an expense involved with caring for our loved ones in the end of life. We realize that. We've seen the numbers. I went over last episode, just the catastrophic effect it's having on the United States and the baby boomers, to which you are one, right?
Right at the end of it.
Okay. So we understand the risk, the exposure is having to our loved ones. So one of the ways we can deal with that is through insurance. What you're saying is insurance is kind of like car insurance. We may or may not need the coverage. And if we don't use the coverage, then many times those dollars could be wasted. But if we did need the coverage, heaven forbid we get in a major wreck, like in a car, the dollars are there to provide whatever the benefit claim we have.
Yep, that's correct. It's one of the best ways to make sure you're covered. However, with the recent trends and what's going on, it's becoming more difficult to get the coverage, and the coverage has become more utilized. So anytime an insurance becomes more used, the costs go up. The insurers have to work on trying to keep the product going in a profitable manner.
So the trends, you mentioned there's trends that are happening. What's happening?
Well, back in the early 2000s, long-term care insurance kind of took off in the 90s, and many of the carriers hopped into this new lucrative market. You can imagine them as an insurer saying, look, we've got all these baby boomers. 15, 20 years from now, they're going to be needing long-term care. There's a great market demand for our product, and we're going to get out there and we're going to sell this product because it looks like it's going to be a real win for the insurance companies, and it's something that people need. And once the educated people who've dealt with caring with a loved one or dealing with long-term care discovers the value of it, they're going to buy it. So the earlier policies were written comparable to like life insurance. Most of the policies were issued by life insurance companies. And so they did their underwriting strategies similar to that in hopes of looking to do that.
Wait, time out. So you said they did their underwriting policies similar to life insurance strategies? Are they talking about actuarial tables or the way they underwrite it?
Yes, the way they underwrite the product. In other words, the product was mainly developed by life insurance companies. So they took their model on life insurance because it's an end-of-life thing. Okay. And they use that model, and then they make some assumptions because there's two topics. Here's another definition for you. There's a topic called mortality, which is when you're going to die. And then there's a topic called morbidity, how long you're going to linger with a catastrophic or critical illness. And those are two different aspects of the insurance. So what ended up happening was the insurers made some assumptions on what's called a lapse rate. That's where a person decides they don't need the insurance anymore. In other words, if you had your car insurance and you decide you don't want it, or you had life insurance and you just were trying to protect an income, you don't want it anymore, it's called a lapse rate. Well, that's a windfall to the insurance company.
What is a windfall to the insurance company? If you have a lapse of policy and you don't use the policy?
Yeah. If you've paid premiums for 10, 15, 20 years, you put thousands of dollars in that life insurance policy and you let it lapse, the insurance company took that money in the pooled risk like we talk about, and they have to pay a death benefit. So that's what I mean by a windfall. They don't have to pay a claim, but they receive the premium for it. The lapse rates of long-term care ended up being significantly lower than that of life insurance. And because of that, insurers had priced the product wrong.
So when you say significantly lower, it means that people were using the coverages, is what you're saying.
They were keeping the policies. They weren't saying, oh, I don't need this anymore, or I'm tired of paying this policy. I'm not going to do that. They saw the value in the policy. So the policies mostly stayed in force, which kind of caught the insurance companies off guard. What happened after that was the assumptions on how long a person stays on care and what the costs of the care are going to be were built in at a 3 or 4 or 5% incremental increase. Well, they've been going up higher than that. So
right there, the 3 or 4 or 5% incremental increase, you're talking about the cost of care.
Correct.
So what we talked about last episode was, inflation is, 4.2% if you're looking at a 40-year average, but long-term care has been in the 12, 13, 14, 16%, depending on where you're at in the country, just really, really high increase. And so they only priced in 3, 4, 5% is what you're saying. And now
they had priced in those costs that way. Yes. And then now the costs have gone up. Instead of having a pool of money left over, and I can get into more specifics about how the policies are done, but instead of having leftover funds that they thought the person would die for, these funds are now being spent by the insurance company.
So in last episode, I talked about the activities of daily living, and I talked about the triggering events of like dementia or Alzheimer's. If we are trying to purchase a long-term care insurance policy today. I know we're going to talk about the companies that are no longer in existence. And guys, there's been a huge gluttony of companies that have just left the business because of that overpricing point. But for sake of time today, I want to make sure we hit the details on a long-term care policy. Let's say that I am now almost as old as you. Let's say I'm old. Guys, I like to pick on Jim. He could probably sue me for age discrimination sometimes.
Every day.
Well, I like to have fun with him. Every one of our clients, we all shoot the bull and just laugh. He says he's the older, much taller version of Justin, and I say
better looking.
Okay. Well, anyways, we pick on each other. We've been together for almost 20 years now, so it's a lot of fun. But let's say I want to go out and buy a policy. Let's say I'm 60 years old, and I want to go out and buy a policy today. Forget the company's name, so to speak. What would I look for? How would an agent design a policy for me?
Well, typically the policies are designed to build in, customized to what your specific needs are. There are a few basic pieces of the pie. The first thing you want to select or pick is the daily or monthly or the benefit dollar amount. Basically, you're trying to insure a cost, and the insurance companies have a defined policy benefit amount. So say right now it costs $5,000 a month for a long-term care, nursing care. You would build a policy up. Most people don't insure 100%. They're looking to protect the loss. So I would typically build a policy that would be maybe instead of $5,000 a month, it would pay $4,000 a month. $1,000 a month would come from your own pocket or income when you do this. So that would be the first part of the policy we'd pick.
Okay, so we first start off with a monthly benefit. I've also seen people do a daily benefit. Is that right?
Daily, monthly works. It's just however you want to count it. There's 365 days in a year, and there's 12 months in a year. So if you do a daily benefit, the numbers get a little different, skewed versus a monthly. Most of the facilities, well, some of them charge daily, but most of them charge on a monthly basis what their charges are.
So whenever the agent designs a policy for me, they're going to pick a daily or a monthly benefit amount and use number 5,000. So I'll stick with that. So we're going to say the 5,000 is the monthly amount that we want to try to insure against. And because I have maybe Social Security income or a little bit of retirement income, whatever, I'm going to choose to insure $4,000 a month.
Correct.
Okay. So that's my first choice.
That's your choice. And then you want to pick what's called the deductible period or the elimination period. It's similar to disability insurance. It's basically the period of time where you pay for care before the policy kicks in. In other words, you've triggered a long-term care event with your activities of daily living or cognitive problems. And then from that point, you pay, usually it's a 90-day plan. You pay for 90 days. And then after 90 days, the insurer will start paying the provider. Usually they have to have receipts or expenses. They'll start reimbursing the expense up to the monthly amount. If you don't spend the monthly amount, they'll pay a lower amount of it. And that's where we get to the next part where we call the benefit period. Okay. And this was awful confusing to people when I tried to sell them the insurance. The benefit period is the period of time. It's reflected in years, but it's really not the number of years you're covered. It's a multiplier that goes in to determine the total benefit pool that's available in your policy. So if you bought a $4,000 a month policy and you bought a 5-year benefit period, that's 4,000 times 12 times 5. Okay. If you spend $2,000 a month instead of $4,000 a month, that 5-year benefit period will actually last 10 years.
Okay. So let me put some math to this. I bought a $4,000 a month benefit for a 5-year period, so for 60 months. That ends up being you use the word pool, so a pool of money, so to speak, of $240,000.
Correct.
If I only spent $2,000 a month instead of the 4, and for the same 5 years, I would have only spent roughly $120,000 over a 5-year period, which means I would still have another $120,000 of money that could last me a year, 2 years, 3 years, however long it'd take to spend that.
Correct. You're purchasing an actual fixed pool of money. It helps the insurance companies because they know exactly what their full loss is. Their only problem was when they earlier priced the product, they didn't anticipate everybody using every last dime of the insurance policy. And that's what's ended up happening nowadays.
So let me just recap for this point because we're fixing to move into a little bit of the weeds here. But for this point, long-term care is a pool style policy, just very similar to car insurance that you're trying to insure against a loss, which in this case, a loss could be assisted living care at a facility. or at home. We're going to dig into the home one here in a sec because I know that's going to open up a can. But we could put somebody into an assisted living facility like my grandmother was. And my grandmother was there for 12 years. So if she had the right pool, the monthly benefit amount or the daily benefit amount times the period of length of time, that gives me the pool of money that I need to provide for my grandmother's care or my care or anybody else's care that's on claim that hit those two activities of daily living or that cognitive issue.
Yes.
Am I right so far?
That's correct.
Okay.
You're listening to the Financially Simple podcast. Show your support by subscribing to this and our other educational business channels at financiallysimple.com.
In the statistic that we talked about in last episode, it showed that the majority, 2/3 currently, of individuals are receiving care at home. And typically, and statistically, 2/3 that are providing care are women. I can see that the men, who I tell my wife all the time, we choose to die sooner. I can see the men needing care, at least the statistics show that, and the women providing care at home. Do these type of policies provide for care at home?
Most of the policies apply the benefit to home, assisted living, or full-blown nursing. The question is the care has to be provided by a licensed professional in most cases. So in other words, if you think, okay, well, I've got my long-term care policy, I'm going to be taking care of home, and my sister's going to take care of me at home, or my niece is going to take care of me at home. With most of the policies, unless she's a licensed provider, and we'll send them an invoice as a licensed provider for care, they are not going to pay a family member for this.
That's interesting. So that right there dashes a lot of people's dreams that I'm just going to get a long-term care policy, get some money to help provide for my wife or husband.
Well, the initial thoughts of this product and the initial thoughts of how this product worked, those ideas have come up, but I'm going to tell you from a financial planner standpoint and a person whose mother's been on long-term care for the last 3 to 4 years, that's not very realistic at times. It's a lot of stress on that individual for taking care of the person. A lot of time, like with my own mother's specific situation, she was a widow living alone, and she went into assisted living, and she actually got better because of the social contacts and the things that go on. There's a stigma attached to going to facilities or doing things that really shouldn't be there, and we should talk about it with our loved ones, and we should talk about it because I run across it all the time. Being a young baby boomer, most of my colleagues and my friends my age are dealing with the same issue with their parents right now. And so the ability to have the insurance or the funding to pay for the care can take a lot of stress. You've already got enough stress with the loved one losing their capacity, but it can take an enormous amount of stress off that and can actually help the children not feel stressed to say, hey, I've got this policy here. When it becomes time, it's time for me to use it.
So with long-term care, is it a medically underwritten policy?
Yes, it is a medically underwritten policy because the tendency or the likelihood of you going on long-term care is based on your health. So therefore, if you have a condition, have developed a condition, heart disease, diabetes, mental illness, cancer, these type of diseases, these are things that affect the chances of you going on long-term care. And just with like life insurance, there are some ratings that are different level ratings on the premium where the premiums go up because your health isn't quite as good or if you have a preferred health situation. In fact, just recently, about 10 years ago, it used to be unisex. It used to be men and women had the same pricing for their long-term care. About 3 to 4 years ago, almost all the carriers went to a sex-based rate because most of the people in long-term care, unfortunately, are women, and therefore their premiums are higher because they experience a higher claims rate than men. And there's a point where you become uninsurable. If you have diabetes that's not controlled real well with a combination of heart disease, or if you're morbidly obese, you're not going to get this insurance coverage.
So you just gave me a good segue. We don't have time to go through how you get insurance. We're just going to say that you can contact your planner like you and I. We would get an agent involved to help them with that. So folks, Jim and I, we are planners. We're fee-only planners. So we're here to try to drive the right content. So you would talk to an insurance agent. But you mentioned something there about uninsurable. I'm going to say that we're probably going to start looking for long-term care in your 50s. Does that sound about right?
Most people buy it in their late 50s, early 60s. I actually bought mine when I was 42 years old, and it's probably one of the best planning devices I've ever used for my retirement planning, which we can have another topic about that. But yeah, and then for the uninsured, there are some annuity products, some life insurance products. There's some underwriting with life insurance, but it could be different than morbidity because it's mortality. So
let's jump into those. Let's jump into those other type of products. So we're making now the assumption that somebody is uninsurable. In other words, they cannot be medically underwritten for morbidity. And you talked about morbidity being long-term care. Then you said mortality was life insurance. How can a life insurance policy cover long-term care?
Some of the life insurance carriers, because they wrote long-term care, have a rider they'll attach to life insurance policy. Again, there are a few morbidity questions that are asked for the rider specifically. So if you've got a really bad chronic morbidity situation, you're probably not going to get the rider on the life insurance. Life insurance is different. It's done. And what it is, it's kind of a prepayment of the death benefit. It also works for the people who maybe they've got the assets maybe for long-term care, but they don't want to deplete them. They think they'll be depleted. My heirs are going to get nothing. The life insurance avenue is a good way to go because what it ends up doing is if you don't go on long-term care, you still have a death benefit. There's still money off those premium dollars that went that way. So that's one. If it's a pure insurable in both situations, then you can look at some of these newer annuity products, and they're basically the annuity company, which they provide income for life. They'll have a multiplier, a 2, 3, or 4 or 5 times multiplier or an income bump up if you go into long-term care, which can be beneficial. You're buying a little bit of insurance from an insurance company without underwriting, and it's kind of like a side benefit to the investment. You can have a little bit of a kicker for your long-term care needs.
So we have a few minutes here left. I want to kind of back up and unpack that life a little bit because that's one of the things we looked at in my mother's position. So after my dad passed away, he could not get long-term care insurance because of health issues. And whenever he passed away unexpectedly, a couple of years ago, we had to deal with, as a family, what do we do with mom? And my grandmother, as we've mentioned, was in assisted living for many, many, many years, over 10 years. I think it was 15 total. I may be wrong on that. And so we looked at the cost. And my brother and I, my brother's a mechanical engineer. He's a math whiz. Jim's a chemical engineer by trade and an MBA and a CFP. We looked at the cost there, and we ultimately decided for that very reason that if my mom did not go on claim, that at least there'd be a death benefit. It's not a good investment return on investment. It's not designed for that. It's designed there to give her roughly $300,000 to $600,000 of benefit should she go on claim. So life insurance can do that, correct?
Correct.
Okay. Yeah. And then you mentioned annuity there, and you went fast. I'm going to slow you down. You said there are annuity products out there that you deposit money into an annuity. So let's use a number here. Okay. Let's say we put $100,000 for a round number into an annuity.
Correct.
And that annuity, you said there was a multiplier. And I think you used number 2 to 4.
2 to 4. With an annuity, when you put a premium deposit in on the annuity, you have an option with many of these products to take a lifetime income. Annuities are really designed for income. That's their main sole and purpose. So the insurance company will ensure that you're going to receive this income for life. Many of the newer products have a little bit of a kicker in it. It's kind of a sales technique where they actually say, well, if it's $100,000, you're going to get $1,000 a month for the rest of your life. But if you go into long-term care, we're going to give you $2,500 a month for the rest of life. Now, there typically won't be any money left in that annuity upon death, but at least it gives you a little bit of a kicker on what to do. And you can kind of wrap up this long-term care. It's a very important part of retirement planning and planning because typically right now, from what I've observed, if somebody goes on long-term care, they're probably going to spend anywhere from $200,000 to $500,000 on long-term care. Most people, if they don't have long-term care planning, they're thinking about it in the back of their minds, and they're saying, I cannot spend down the principal of my IRA. I cannot spend down the principal of my retirement funds, because if one of us goes on long-term care, I've got to have that money there. One of the things is if you get some planning of long-term care into your plan, you can actually say, how are we going to pay for this? And in many cases, if you're eligible for the insurance, it's not cheap. But if you look at it, you can sit there and say, okay, I don't have to save all my principal. I can enjoy my retirement, especially when you're in your 60s and 70s. You're able to maybe bump that income up a little bit, knowing that when I'm 85, I've got a long-term care plan and this is how it's going to be paid for. And so that's one of the things you need to look at. You just need to put it in a part of your planning process, whether or not you can afford insurance, whether or not an annuity product is best, or whether or not you're just going to have to hold on to what you can. And then there is a safety net of TennCare for Tennessee or Medicaid that eventually is a safety net that does catch you, but that ends up depleting all your assets.
So folks, Jim just wrapped that up with a little bit of a reason why long-term care matters from a planner's perspective. As I mentioned, he is a CFP, a certified financial planner. Jim deals with our clients in this particular area of planning. This is one of the areas that I believe is often underutilized or underserved. But if you're working with a CFP, at least one that works in a planning avenue, they're going to look at this most of the time. And you guys know, you're going to hear about it. I think annuity is a bad word oftentimes. I think they're often sold. There's a reason and a place and a time to use those, although very sparingly many times. And I think the insurance market often abuses those, just like I believe that there's a time and a place to use a permanent life insurance product. As I mentioned a couple of episodes back, I think the majority of people should have term insurance, especially business owners. I really believe that. But there's a time and place. So we're going to continue laying the groundwork, and then we're going to circle back around in a few dozen episodes from now and start working on all these little quirks on how you may need to use an annuity for long-term care and retirement. We'll have Jim back on the podcast at that point. But folks, you can check out Jim on the Heritage Investors website. You can read about his bio. Like I said, he's one of my best friends in the world. We have gone through a lot together, and we're going to continue to go to a lot together. He can't get rid of me. He often says that we're going to be in heaven. He's going to be a next door neighbor. And I said, I don't know about that. I'm going to probably try to leave her. So we like to laugh and have fun. But I hope you guys enjoyed this episode on the Financially Simple podcast. If you have any questions as it relates to long-term care, shoot them my way, and I'll get Jim to reach out to you and answer them for you. We're here to serve you. I say it every week, guys. Life is hard. Life is good. Life is always good, isn't it?
It's very good.
Life is good. It's hard sometimes, but it's good. Life can be frustrating. Money, especially insurance, it shouldn't be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.
You've been listening to the Financially Simple podcast. For more business and personal financial help and information, head over to financiallysimple.com today.